We're dealing with Capitol Hill here. We're dealing with a very, very volatile issue here. We're dealing with all sorts of interest going back and forth. We're waiting for the bankers lobby to go ahead and start rallying on Capitol Hill. Anything along those lines, it is crazy right now. So moving on, let's talk about those annual taxes. Some issues, some partial answers at least. The issues, the highest rates may increase. You got income taxes we saw from 37% to 39.6%. You've got capital gains going from 20 to 37% at the highest rates. Some partial answers. Harvest your gains now. That's kind of flipping the term a little bit. You usually talk about harvesting our losses. Maybe we had losses in the past of something like, I'll throw out some numbers. So we had $50,000 in losses in the past, but this year in 2021, we had $30,000 in gain. Well, guess what? We can use those taxes, we can use those losses to offset. And we've now offset that $30,000 with the $50,000, still leaving us with $20,000, right? Well, same kind of thing when we look at what we have for the gains, but now it's a little different. We're looking at that tax rate that we see perhaps 20 to 37% there, okay? And we realize that maybe we want to pull back. If this is what's going to happen with this capital gains rate, let's take some of our lumps now. Let's maybe sell some of the things that we have that are going to cause us those capital gains. So Bob, for example, with this DTE stock, I'm really picking at a lot, Bob, sorry about that. Bob, with this DTE stock, for example, was at 10,000, went to 55,000. He's going to be paying taxes on 45,000 of that at a higher tax rate next year. So this year, he takes care of making sure he just sells it. Now it becomes cash. Cash doesn't have depreciation value with that, does it? Next one. Now we're into gifting. To gift or not to gift? That is the question. Who had to read Shakespeare in high school? Who had to read Shakespeare in college? Some as well. Who just enjoys reading Shakespeare? Some as well. Okay, yep, all right. Gifts may rise to 37%, and the total amount of our gifts may be restricted to $30,000 if we go with Senator Sanders' plan. Advice? Carefully consider whether to gift to individuals, keeping in mind charities are okay. Perhaps consider gifting only cash. We talked about a little bit about it before. Only cash, because you're not going to get hit with the capital gains, the issues that come up from having the raise in the value that's there. We avoid that gain recognition. And then, of course, donating capital gains property to charities. So take a moment over the course of the next several weeks, months, and decide to yourself whether or not there's some charities that mean something to you. What's the name of the charity here? Benevolent Fund?
Resident Care Fund.
Resident Care Fund. The Resident Care Fund, for example. Think about all the things that you get from being here at Fox Run. The wonderful people who are here, the assistance that you get every day. Maybe it's worth considering, is now the time. Maybe now is the time to consider, hey, let's get rid of that capital gains thing because I know that we're going to get hit with that next year. Or any time in the years to come. If you gift capital gains property, ones that have the significant hits, you're not going to get taxed on that. So think about it. Let's go back to the DTE stock. The DTE stock, $75,000 at the time that you were going to think about selling it or giving it, and put that $75,000 in cash against $75,000 in the appreciated gift, which had $65,000 of exemption. I'm sorry, $65,000 of taxable increase, and you're dealing with a night and day difference. Keep the cash or give it to your friends, give it to your loved ones. your children, your grandchildren, whoever, take the appreciated asset and gift that to charity. Critical point. Next thing we're looking at is state tax exemption now. Planning for a lower estate tax exemption. Ladies and gentlemen, I hate to say it because I was all for it before, but we're now in a position where we are going to have the estate tax exemption coming down. We're not going to be at 11.7 by the end of this year or sometime in the next year, whenever they finally get around to setting it up. So what do we do? First of all, let's take a look at this. I decided, don't put this in any slide, just leave it as a slide by itself. What does your money represent with each of these three hands? These three hands may be loved ones. Could be children, grandchildren, nieces, nephews, could be friends. Or we could be saying, President Biden, we got Senator Sanders, and we got Senator Van Hollen there. Now, again, I'm not taking a stance on that. I'm just saying, what does that mean to you? Let's get back over to our estate tax exemption. So, of course, we've got potentially going from 3.5, and I don't want to scare anybody. There has been some discussion that it'll never go down to 3.5. There's some discussion about it's going to be 5. And you need to be aware of that. We don't know where it's coming down yet. The estate tax rate up to 45%. If Senator Sanders' plan is proposed and passed, now here's where we at. $45,000, 45% up to $10 million. 50% up to $50 million. 55% up to $1 billion, and that 65% comes in above $1 billion. So is Sam Welton here today? Sam Welton? No, I don't think so. Okay. Oprah? No. Okay. Anyway, they might be hit by that. All right. Some possible answers. Husband and wife credit shelter trust. This is something that was extremely popular back in the 1970s, 80s, and 90s. Because back in the 1970s, we had a state tax exemption of $600,000. And then it grew to $1 million, and it grew up, of course, where we are now, right now, $11.7 million. As it grew and grew and grew, it didn't make as much sense to have that with a husband and wife credit shelter trust. But essentially what happens is, can I get a husband and wife to go ahead and raise their hand for a moment? Just for a second, we'll pick anyone. Okay, and your names?
Jay.
Jay? And?
Joyce.
Joyce. So Jay and Joyce, for example, smart people. They say, you know what? Together, if we have a joint trust, we can only have the maximum of one of these, $3.5 million or 5, whatever it ends up being. But they say, wait a minute, we can double this. Jay says, I'll set up the trust, and I'll go ahead and I'll put in $3.5 million here. And Joyce says, I'll go ahead and set up a trust too, and I'll put $3.5 million in this one. And you're essentially sheltering a certain amount. Now, when one passes away, the surviving spouse has his or her money in his or her estate or trust, and the other's there if the surviving spouse needs it as well. But once surviving spouse passes away, in this context, Jay and Joyce's children will be able to have the money with no taxes on up to $7 million or maybe $10 million. We'll get into that in more detail in a moment. Irrevocable trust. Now we're talking about, anybody ever hear about an ILIT? Is an irrevocable life insurance trust? They're out there and something to be talked about. And DAPS. We'll talk about that as well. That's a domestic asset protection trust. And Doug, who's here with me today, knows all about those too. Charitable giving is also something else we'll talk about. So we got possible answers again. Husband and wife credit shelter trust. Each spouse basically puts a certain amount in there, but then we ask about, what about the excess? And Jay and Joyce had $100 million. Just kidding, Jay and Joyce. Although it'd be nice, wouldn't it? The bottom line on that is that, hey, there's an amount that might exceed the $7 million or the $10 million that we're able to put away. So we look at irrevocable trust. Irrevocable life insurance trust. Yeah, that's basically buying a life insurance policy that will provide us with the face value of the expected tax that we'll have on the amount over the $7 million or $10 million exemption? Well, you got to buy insurance. And you've also lost control because now it's an irrevocable trust. Remember how I mentioned before the non-grantor trust? Well, that's pretty much what we're dealing with there again, okay? This is a domestic asset protection trust. Domestic asset protection trust, guess what? Wasn't made for this context. The domestic asset protection trust was made simply for purposes of doctors, lawyers, accountants, celebrities, people who are targeted in one way or the other, based upon the nature of their profession or based upon how they might potentially have a excess liability coverage lawsuit. Doctor, amputates the wrong leg on surgery or something like that. Now he's got a, $100 million lawsuit against him, and he's got a $10 million coverage, and so $90 million, something had to go somewhere. Well, it allows those individuals to put money into these irrevocable, non-grantor trusts. They can't get to it under certain circumstances, they might. And the others being the creditors, can't get to it. But there's use in the context of our estate tax exemptions and where we're going with the tax law right now. Domestic Asset Protection Trust, Michigan is just one of 17 states to even have this. It's an irrevocable trust, which means it's not counted as part of your assets. So let's take that silly example that I just made a moment ago. Say we had $10 million that we had all together. Say it's a $7 million estate tax exemption, I'm changing it a little bit. And we have $3 million that we want to go ahead and avoid that estate tax exemption against. The way we avoid that is by essentially setting up the Domestic Asset Protection Trust. Because that $3 million that was above the $7 million I just mentioned a moment ago isn't counted. It's not counted. Someone else is a trustee managing your assets. Now that probably doesn't make you feel extremely comfortable, but there's something in the Domestic Asset Protection Trust that made this a little bit more attractive. You still maintain some control. You've got the power to direct, basically not veto, but some of the investments that your trustee is making. You've got the power to veto certain distributions as well. You can't have that in an ILIT, the Irrevocable Life Insurance Trust. It's not set up that way. This is set up during the course of your lifetime, and it's set up with actual access money. But you can see in all capitals I've got there. This should be used for assets you don't need immediately. Again, take that example of $10 million versus $7 million. The laws perhaps only allow us to go ahead and shelter $7 million if we're married. If we're single, $3.5 million. So what do we do at that point? If we're single and it's $5 million, do we want to be taxed at $1.5 million? Please, by show of hands, how many people would like to be taxed on $1.5 million? Nobody? Nobody? Right, exactly. Okay? That's the point, is we have this area that we can put that money that we do not want immediate access to into a domestic asset protection trust. I also refer to it as a DAPT, as you can see. Going into the next area, weathering the attack handle Senator Van Hollen's approach. Again, I don't know if this is a trial balloon or if this is a crusade or somewhere in between. So how do you weather that attack on capital gains? The Hollen STEP Act, if passed as proposed, would be retroactive. Again, I mentioned to you before, many say STEP will not be retroactive because there won't be enough congressmen and being senators and representatives to go along with it. Advice: carefully consider whether to gift to individuals, and charities, though, seem to be okay. Perhaps consider establishing a marital trust with disclaimers. I'll explain what that is. That's an important area, though. So how can a marital trust help? It's a direct way to address the STEP Act with the disclaimer, and this is the code section. The trust essentially provides the donee spouse. So husband donates to wife, wife donates to husband. In the context of a trust, that spouse has a right to life, right for life to all interest income, okay? The donee has the right to appoint all or a portion of that interest. Appointing means if I die, it goes to so-and-so. If it happens this way, it does this. It's making decisions, essentially, with the assets. And then they can provide it, assigning it, appointing it right back to the surviving spouse or his or her estate. There's no gain recognized under Senator Van Hollen's STEP because it's a transfer to a U.S. citizen spouse. Now, sadly, I can say that for those of you who are not U.S. citizens, for those of you who have friends and family members or whoever it might be that are not U.S. citizens, this will not work. However, provided that you're a U.S. citizen, this approach will work. And you have a couple options here. If the STEP doesn't come to pass, then the spouse can just claim that money directly to the trust. If the STEP does come to pass, then the assets can be left in the trust and you can't tax it. It can be left in the trust and you can't tax it. That's the answer to the worst case scenario that we see so far. How can charitable gifts help? By trust, we've got a couple of different options. Again, remember, as I mentioned all the way through that chart, our gifts to charity, as you all know, are tax-free. But there are certain ways that we can make a partial gift to charity and the remainder to a loved one and still get the tax cleansing. So we look at the charitable remainder trust and the charitable lead trust. Remainder means for a series of years, year after year after year after year, I'm giving to my charity. Maybe it's to the Fox Run, maybe it's to United Way, maybe it's to so many different charities. That's the lead trust. The charitable remainder is year after year after year, I gave to my loved one, but there's a big pot at the end that I went ahead and gave to my favorite charity. These can provide for capital gains avoidance through the charitable remainder trust. They can avoid for charitable income tax deductions through the lead trust. Reduction of taxable estate. Again, think about the context of, instead you decided to go ahead and do something along the lines of that $5 million that you had, and you have $3.5 million that you have exempt. With that additional $1.5 million, you can set up either a charitable remainder trust or a charitable lead trust. It cleanses that $1.5 million away from taxing. Instead of the government telling you where you want your money to go, you decide, hey, this is my favorite charity, and these are my loved ones that I want to provide to. You can also provide an income stream for a term, again, for both of those, whether it be the remainder